You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, well, a while back we talked a little bit about Disney, and I want to kind of look at that trade. We talked about a calendar spread in Disney, and that's how we're going to start out the show here today. When we looked at this calendar, Disney, it was July 14th. It was a Wednesday, and I should let you know we are taping Options Playbook Radio once again on a Wednesday. The markets are closed. It is the 21st of July. When we looked at Disney last, the stock was trading at 183.42. The chart kind of looked fairly good at that point in time, and we knew that there were earnings that were coming out. So we specifically looked at a calendar spread and bought the option contract that expired after earnings. That expiration was August 13th. And sold an option contract that expired more near term, which was a July 30th expiration. We picked a 190 strike, so we leaned bullish on this trade. And ideally, we would have liked the market to actually go up towards the 190 strike, but we wanted it to do it in a slow fashion, right? Ideally, we would like it to be just shy of 190 before that July 30th expiration date. Well, with that said, that did not happen. So on Options Playbook Radio, it's always good to talk about situations where the stock didn't go where you wanted it to go. So what could we do now? So as of today, Disney is closed at 176.89. It was up a few pennies on the day today. And that means that the market is down around $8 from when we first put on that trade. So if we look at that calendar spread, it is trading for right around 91 cents at the midpoint. We put it on for $1.91. We are down about $1 on the trade. So what would you do now? Well, I would look at the chart, try to decide what I think is going to happen with Disney in the short term. That would be the first thing that I would want to do, is try to apply some technical analysis to this. But overall, we limited our risk quite a bit by buying the 190 strike call, and we didn't just buy it outright. I mean, ultimately we were bullish overall, and that could have been a possible trade, but we sold a nearer term option against it. And that option contract was trading for, at the midpoint, right around $1.21. So it did give us a lot of protection by selling that option contract. That option contract now is currently trading for around 14 cents. So we could just close that out because we had the downturn and just remain long the 190 call. We still have an earnings report that is happening. So if we did that, then we basically would be profitable on our shorter term option. We would have captured most of that time premium, and then we'd still be long the August 13th expiration 190 call option. Now, personally, I would probably just let it ride because it doesn't really hurt us if that underlying starts going back up. But you're quite a bit out of the money. You have a few more days remaining to that expiration date. But if you did get a quick pop up, it would definitely behoove you to just be long that call option. So you got to make that decision on your own. The other alternative is to just close out the trade. You were risking $1.90. You've lost about half of it. Just get out of the trade and move on. That's a very feasible thing to do at this point in time. I personally would probably just keep the position on because I managed my risk by when I initially put on that trade, and I would like to just stick around and see what happens with earnings and see what the overall risk of that trade would be. So that's ideally what I would look at. I don't have any idea what would happen with Disney and with earnings overall, but we put ourselves in a strategy where we had real solid conditions, and that we expect the implied volatility of that August 13th expiration to increase, which would help us out because we're long that contract. We were hoping that the shorter term option would decay, and that did happen. But unfortunately, the stock has gone down more than we would have anticipated overall, or we probably wouldn't have put the trade on to start with, obviously. So I think I would just, in general, just stay the course and realize that, yes, I could sell this for $1. And right now, that would be my risk for this trade if I wanted to stick in this trade going into earnings overall. We do know that the July 30th expiration will expire. Another option, and this would be our last option, is to let that expire and then maybe sell a different call against it, because we're going to have one more week before that August 13th expiration date. So we would go on out and look at the July 30th expiration, and maybe we could even whittle away a little bit more on that 190 call strike that we paid. So there's still going to be one more opportunity before that earnings announcement to sell a call against the position. So we're incorrect on our forecast, but we had ourselves positioned pretty well overall. So stay the course. All right. Now, with that said, Nvidia and just did a big 4-for-1 stock split. And today we see the stock is trading up quite a bit. It's up $7, $8. Last trade was $194.10. And once again, we're taping Options Playbook Radio on a Wednesday. The markets are closed. It's the 21st. So I wanted to look into it just because it's in the news a lot. A lot of people are thinking about it. And I wanted to try to look at a strategy that maybe we could implement in this underlying stock. Vols are a little bit high. They did announce earnings about a month back, I think it was now. And so we're not that concerned about earnings, but we just overall have volatility in the stock because it's being so heavily traded. We had a big run up in price, then we had a big drop down in price, and now we're going back to the situation where we got a little bit of a spike in price, as we saw today with the stock running $7.98, based off of the fact that it's now almost a $200 stock in that area. So the one thing that I would look to do if I was going to place this NVIDIA trade is the options are expensive. So we're going to go out and just look at a butterfly. Now, I looked at skip strike butterflies, but there is a weird skewing in the volatility on NVIDIA. I really kind of wanted to do a skip strike butterfly and get it done for a fairly low price overall. Hopefully a net credit to the account. But because of the way the options are priced, it really just wasn't feasible to do. So I opted for just doing a standard butterfly in NVIDIA. And we're going to do a real short-term one. And it's going to be a speculative trade, but we're not going to risk a lot. Obviously, if you use the leverage factor in options, you can risk almost as much as you want to. But this is not meant to be a recommendation. I'm just looking at NVIDIA because I know that a lot of people are thinking about it. So if I were to do a short-term speculative trade based off of where the underlying stock is at and the move in the stock today, I would look at doing a very inexpensive butterfly. So here's the trade that I would look at. I'm going to do the July 23rd expiration. So we're just going to go out till Friday. And we're going to be buying the 197.50 strike call, selling the 200 strike call, and then buying the 202.50 strike call. It's going to give us a 5-point landing area. We can get this entire trade done for a net debit of 22 cents for the account if we can get a midpoint fill. Don't forget, you got to put commissions in on that trade too. And so if I put this trade on, I don't have a lot of risk overall, 22 cents, especially if I'm just doing it as a 1x2x1. That means $22 plus commission is my maximum risk. And on my upside, the most you could make if you're dead right would be $2.50 minus that 22 cents, obviously. But that's not my goal. If I put this trade on and I'm risking 22 cents, if I could get out for 50 or 75 cents, somewhere in that range, that's where I would be looking to exit this trade. And we're doing it so short term that if we did get that run up towards that 200 strike, which is a nice round number, and it's part of the reason why I targeted that range, is that if we do get towards that strike, we should get rewarded fairly quickly on the butterfly. And the reason behind that is because we're doing such short-term options we're doing such short-term options, and there's so much implied volatility in those option contracts right now. So the most at-the-money option contract, just to talk about volatility, is right around 43% in Nvidia. So with a 43% implied volatility, we got a few days remaining. We can get this 2.5-point wide butterfly done for a fairly deep price. This would be one way that I would look to speculate on it. So as opposed to buying a call option, obviously you have unlimited upside and everything that goes around with it. But if I just bought the 200 strike call option, I'd have to pay 60 cents for that on the asking price. So that's just fairly expensive to ask the stock to move another 6 points up to the upside. And I'm paying 60 cents with only 2 days remaining to that expiration date. So you would have all day Thursday, all day Friday for that option to live. I would rather do something where I don't mind if time decays. I don't mind if implied volatility comes down. And hence the reason why we're talking about the butterfly today. So that's going to be it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer in the program, you can send them directly to me at theoptionsguy@invest.ally.com. Please check me out on Twitter. My handle is @BrianOverby. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.